96 years ago, the crash of 1929 happened. The crash was bad, real bad. The US was scrambling for solutions. Enter the Smoot-Hawley Tariff Act of 1930. This piece of legislation dramatically increased tariffs on thousands of foreign goods. And while the crash had many culprits, economists now believe this act deepened and prolonged the Great Depression, turning a severe downturn into a truly devastating economic crisis. Fast forward to 78 years ago, this baby was born. Fast forward to 4 months ago, that baby became the President of the United States again. Fast forward to a few days ago, he created chaos in global trade. His name? Donald Trump. He is doing something very similar to what was done before. In fact, if all Trump's tariffs go into effect, we'd be looking at tariff rates last seen in the 1940s. But how will this affect you? Well, we're going to talk about it. This video will be long. This video will be packed with information. Grab a cup of coffee, maybe some boba tea, and buckle up, buttercup. You know tariffs are happening. It's the one word you hear 75 times a day. And you, as an investor, needs to know how this may affect your investments and also why they're being affected. Investors face a critical challenge, identifying which companies will weather the storm and which might sink beneath it. But not to worry, you're in the right place. By the end of this video, you'll understand in simple terms the following 5 things. What are tariffs? Which tariffs are in effect? How tariffs may affect US companies? How all this may change consumer behavior? And what history tells us to do in moments like this. Okay, to kick us off, what are tariffs? I see so many people throw around big words and jargon, but in simple and direct terms, a tariff is a tax that a company has to pay for importing stuff from a certain country. So when Trump says there's a 25% tariff on Mexico, what it really means is that companies importing stuff from Mexico will have to pay a tax equivalent to 25% of the price of that thing they're importing to the US government. Say a company imported a t-shirt for $100. Now, with the tariff, the company will also have to pay an additional $25 in taxes to the government. The issue with tariffs is that while companies importing goods are the ones who directly pay this tax, this increased cost is often passed on to consumers in the form of higher prices. So take the tariff on cars announced on March 26. That tariff will increase the cost that manufacturers like GM have to produce their vehicles. And because businesses need to make a profit to survive, they will need to pass some or all of this extra cost to consumers. Okay, so companies importing stuff will pay more. But what about the retaliatory tariffs against the US? How does that affect American corporations? Well, those retaliatory tariffs apply to American companies that are exporting their products. Take China, for example. They're currently charging a 125% tariff on all US imports, as announced on April 11th. That means that Apple could suffer a double whammy of tariffs. They will pay tariffs to the US because they're importing the iPhone that's assembled in China, but the iPhone may also be subjected to tariffs from China because Apple sources chips and some other components from the US and exports them into China. So to sum it up, we have 2 things. 1, US tariffs will cause American companies to pay more to import things. And 2, retaliatory tariffs may reduce the demand for companies exporting their products, since they could cost more, or if they manufacture things internationally, they may suffer a double whammy of tariffs. But even if there was no retaliation to the US tariffs, the government is making trade more difficult, undeniably. It's making the life of American companies more difficult, at least in the short term, and it's harming the economy of the country targeted by that tariff. When I say this, what it really means is that you and me and people from countries who had no say in who would lead the US are the ones who will really bear the consequences of a trade policy like this. Now, which tariffs have been imposed? Well, honestly, this is a bit hard to answer in this video, as you never know how long the current tariffs will be in effect for. But as of filming this video on April 14, this is the US tariff status. We have 6 main categories of tariffs, which I'll try to cover in a simple way. First, you have the baseline universal tariff of 10% that applies to most goods imported from nearly all countries worldwide. 2. There was, for a brief period of time, higher reciprocal tariffs ranging between an additional 11 to 50%, which have been paused for 90 days. They were announced on April 2nd, followed by some great financial advice from DJT on April 9, followed a few hours later by the government announcing these tariffs were now paused from April 10th until July 9th. During this pause, imports from nearly 57 countries targeted by these reciprocal tariffs are subject only to the 10% baseline tariff I mentioned before. Now, China, Hong Kong, and Macau face different tariffs. The combined effective tariff rate for them is 145%, which is composed of a 20% tariff implemented in February and March, and an additional 125% reciprocal tariff implemented on April 10. This rate was increased sharply from previous levels in response to retaliation by China. However, there is an exemption for electronics that was announced on April 11th. Certain electronics such as smartphones, laptops, semiconductors, and more were exempted from the reciprocal tariff layer, the 125% part. So they still suffer the 20% tariff. The fourth category of tariff is on steel and aluminum, where a 25% tariff applies to imports from all countries in the world. This includes certain derived products like beer cans. Fifth, there are also tariffs on vehicles and auto parts, with a 25% tariff being applied to imported vehicles globally, effective April 3rd, and a 25% tariff that applies to imported auto parts globally, this one coming into effect on May 3rd. Finally, we reach our neighbors, Canada and Mexico, and here it gets a bit tricky. They are exempt from the 10% global tariff and the currently paused reciprocal tariffs announced on April 2nd, Liberation Day. However, trade is still significantly impacted by the earlier tariffs on non-USMCA goods and the global tariffs on steel, aluminum, and vehicles and auto parts. The USMCA, you may ask? Well, the USMCA rules of origin are a set of criteria used to determine if a product qualifies as being from the United States, Mexico, or Canada region for the purposes of the trade agreement. The main goal is just to ensure that the benefits of that agreement, primarily duty-free treatment, are granted only to goods genuinely, legitimately produced or significantly transformed within North America. This means that if goods imported from Canada or Mexico do not meet the USMCA rules of origin, they are generally subject to a 25% tariff, with specific exceptions for Canadian energy and potash, which is a fertilizer, from both countries, which are taxed at 10%. Goods that do qualify under the USMCA rules remain duty-free, i.e. no tariff. Now, despite all these tariffs, there hasn't been a widespread reaction from other countries retaliating against the US. Not yet, at least. In summary, the most significant active tariff retaliation against the US goods currently comes from China and Canada. The EU's planned retaliation is on hold pending negotiations, and Mexico has delayed its response. Most notably, China recently cut the export of rare earth minerals to the US, which are key to the development of several applications. Okay, so we're getting to the bottom of this. So how will this affect US companies? With all this context, we can basically assume two things. First, that companies that rely heavily on importing goods, whether finished products for resale, components for manufacturing, or raw materials, are the most directly exposed to tariffs imposed by the US, which will increase their operating costs and put pressure on their bottom line. So, based on the current tariffs in effect as of April 14th, here are 5 of the most exposed sectors and companies. First, you have retailers, since they import vast quantities of finished consumer goods, a large portion often sourced from China, which is now facing 145% tariffs, or other countries subject to the baseline 10% tariff. Examples of affected companies are Walmart, Target, Costco, Best Buy, and dollar stores. They face higher costs on imported apparel, electronics, household items, furniture, and so on. Second, you have apparel and footwear companies. That's because of their heavy reliance on manufacturing facilities in Asia, particularly China and Vietnam. This means they manufacture abroad and need to import back into the US these products, which are then subject either to the baseline tariff of 10% or, in China's case, the severe 145%. Examples of this are Nike, Adidas, Gap, and many other clothing and shoe brands. Third, it's the consumer electronics and tech hardware companies. That's because of the complex global supply chains that are heavily centered in Asia, in countries like China, Taiwan, and South Korea, for components and final assembly. These companies are exposed to the 10% baseline tariff and the 145% China tariff regime. Though it was recently announced, some finished products like smartphones and laptops were recently exempted from the newest 125% layer, with only the older 20% tariff still in effect. Examples are Apple with the iPhone and Mac assembly, Dell, HP with their laptops and servers, Cisco, Nvidia, AMD, and the list goes on. Fourth are the automotive manufacturers and parts suppliers. These companies face a complicated combo of tariffs. The 25% global tariff on imported steel and aluminum, the 25% global tariff on imported vehicles, and the upcoming 25% global tariffs on imported auto parts, which will go into effect in May 3rd. Most of these companies rely heavily on imported parts, even for vehicles assembled in the US, with usually 40 to 50% of car parts being foreign. Examples are Ford, General Motors, Stellantis, the parent of Chrysler, Jeep, and Ram, Tesla, foreign automakers with US plants, and more. And finally, you also have industrial goods manufacturers and companies that use steel or aluminum. That's because direct users of imported steel and aluminum face the increased raw material costs due to that 25% tariff. Examples are companies in construction, heavy machinery, appliance manufacturing, and can makers like beverage companies. These companies face direct pressure on their cost structure due to the US import tariffs. They must decide whether to absorb these costs, reducing profit margins, pass them on to consumers, potentially reducing sales, or attempt complex and costly shifts in their supply chains, which the current administration has stated as their goal to bring back manufacturing to the US. Okay, so those are some of the sectors and companies most affected by the US tariffs, i.e., they rely on imports in some way, shape, or form. Now, the second thing we can assume, based on this context of global trade war, is that companies that have a significant portion of their revenues coming from international markets, especially those imposing retaliatory tariffs to the US, such as China, could see a significant decrease in their sales, given that these tariffs will likely increase the final price of US-made products for consumers and businesses in those foreign countries. In a scenario like this, we could well see companies suffering a double whammy of tariffs, paying US tariffs for importing raw materials within their manufacturing processes, and later having their products incurring Chinese tariffs if they're to sell their product there. You increase the costs at the start and the end of the product lifecycle. Okay, but who cares? These are American companies. Surely most of their sales are here in the US, right? Well, yes and no. Yes, in the sense that, in general, most American companies' revenue do come from the US. And no, because according to data collected by S&P Global, nearly 29% of revenues of companies listed in the S&P 500 come from international markets. It's true, and I mentioned this in the video already, there hasn't been a lot of retaliation against US goods, except from China and Canada. But since China is the bigger market, just as an exercise, we can have a look at some famous American companies that have a significant exposure to that market, and thus will likely be affected by their 125% retaliatory tariff. Nike has 15% of its revenue coming from China. Apple has 16%, aside from estimates that say that 90% of iPhones are assembled in China as well. Starbucks has less than 10% of its revenues coming from China, but almost 20% of all their stores are located there. Starbucks opened around 7,000 stores in China in the past 10 years. Intel, with 29% of revenues coming from China, its biggest international market. Tesla, with 21% of its revenues coming from the Red Dragon country. Plus, its Gigafactory located in Shanghai is estimated to produce more than half of all vehicles produced by Tesla. And this is just to name a few. But the thing is, tariffs will not affect only companies. The ripple effects of this new tariff-driven world will be felt by us consumers. And with that, the winds of change. Consumers will likely face higher prices. Tariffs increase the cost of goods and will likely lead to noticeable price hikes on items like apparel, footwear, electronics, vehicles, and potentially even groceries. A study by the Budget Lab at Yale estimates an average loss per household of up to $4,900 annually because of tariffs. People are concerned. Surveys show that a large majority of consumers are concerned about their impact on their personal finances and the broader economy. This uncertainty dampens consumer confidence, which historically correlates with reduced spending. And with that, we could see a shift in spending habits, with consumers actively changing how they live their daily lives. In moments like this, people will usually prioritize needs over wants, with their spending being focused mostly on essentials like groceries, housing, and utilities. People will delay purchases, putting off non-essential things until prices stabilize. And there is a reduction in overall spending. Consumers cut back on spending across the board, especially on non-essential goods and services. Discretionary spending on items like entertainment, dining out, travel, and so on see significant cuts. In this scenario, there are a few companies that may benefit though. Retailers like TJX, which operate stores like TJ Maxx and Marshalls, known for attracting price-conscious consumers, may see increased sales. Its business model, which focuses on purchasing overstock and closeout merchandise, positions it well to offer competitive prices even as tariffs impact other retailers. Etsy, the online marketplace for handmade stuff, may benefit from consumers seeking domestically produced items, especially when imported goods face higher tariffs. And surprisingly, Costco, with its so-called treasure hunt structure that allows it to adjust its merchandise mix more easily than others, and possibly source products from countries that are not subject to the tariffs. CEO Ron Vakras said, "With our flexibility, there are not many items we can't find something else to replace or something else to bring in that category." And finally, Netflix. With consumers going out less and being more conscious about their spending, Netflix will likely be the one entertainment people continue spending on. Netflix may be the ultimate defensive stock. So what should you do? We've walked through how these recent tariff policies have sent shockwaves through the market. It's unsettling, no doubt about it. But in moments of uncertainty like this, it's helpful to zoom out, to look at the big picture. Market volatility driven by policy, politics, or economic events is not new. This is where long-term investing truly shows its value. Market history is littered with scary events, geopolitical crises, economic downturns, policy shifts far bigger than what we're seeing now. Think back, the great financial crisis of 2008, the dot-com bubble, Black Monday in 1987, and countless other events. Each felt unprecedented at the time. Each caused panic, and yet, every single time, the market eventually recovered and reached new highs. Why? Because underlying economic growth, innovation, and corporate earnings tend to drive markets upward over decades, even if policy creates bumps, sometimes big bumps, along the way. Morgan Housel said it best. Just read this book, a book called Shut Up and Wait. Each page is just this chart. And this is why a long-term mindset is your superpower as an investor. While short-term traders try to navigate the chaotic waves of news about tariffs or Fed decisions, long-term investors focus on the tide. By staying invested, you're harnessing the long-term growth potential of the economy. Think of it this way. Every major market downturn in history, driven by whatever crisis or policy, has eventually looked like a blip on a long-term chart. The key is staying on that chart. Trying to dodge every dip often means missing the climb back up. According to studies, the best recovery days often happen within a week of the worst days, and missing them can cost you a lot. So instead of reacting emotionally to tariff news or market drops, focus on your financial plan. Are you diversified? Are you investing consistently? Are you focused on your goals, whether that's retirement, a house, or financial independence? That's what matters. Navigating these choppy waters is part of the investing journey. So yes, you can acknowledge the headlines about tariffs and market swings, understand the potential impacts like we discussed, but don't let it derail your long-term strategy. This volatility, while uncomfortable, is the fee we pay for the long-term returns that the market can offer. Don't let short-term policy noise dictate your long-term financial future. Use this moment as a reminder to check on your strategy, not to abandon it. Stay calm and remember that time is your greatest ally. The real path to building wealth has not changed. It's about having a plan, investing consistently in diversified assets, controlling your emotions, and letting time and compounding do the heavy lifting. So, take a deep breath. Focus on your long-term goals, not the daily headlines. Stay disciplined, stay invested, and trust the process. The power isn't in predicting the next policy move. It's in patience and perspective. As you can see, tariffs can have enormous repercussions, and it's hard to predict the winners and losers of Trump's tariffs. So what's the bottom line? Instead of trying to predict every policy twist and turn, focus on understanding what actually makes companies resilient. In the short term, there are two things we can say with some level of confidence. Companies with domestic-focused operations give them a natural shield against tariff impacts, and that companies with these three critical weaknesses will punish them most. Relying on complex international supply chains, razor-thin profit margins that cannot absorb higher costs, and limited pricing power to pass those costs onto consumers. Businesses with real pricing power can pass costs downstream without losing customers when tariffs hit. And companies with flexible supply chains can pivot quickly when trade rules change. Thanks for sticking with me through this breakdown. Drop a like if you got value, subscribe for more, and let me know how you're navigating this tariff-driven world in the comments below. And if you're new to my channel, I recommend you watch this video next as I discuss some of the ways you can diversify your portfolio effectively. As always, stay savvy, stay patient, and I'll see you in the next one. Ciao.